So you're thinking about retirement, right? Most of us are obsessed with that one big question: how much do I need to save? But what if I told you that where you choose to live could be the single biggest financial decision you'll make? We're about to dive into how your zip code could be quietly siphoning a fortune from your nest egg, year after year. Let's get right into it.
Let's just start with a huge number, shall we? $200,000. Yeah, over a 20-year retirement, that's about how much extra you could fork over in taxes just for living in the wrong state.
And just so we're clear, this isn't pocket change we're talking about. That kind of money, well, that's the difference between taking that dream cruise around the world, helping your grandkids with college, or, just having the peace of mind you've spent your entire life working for.
So it all boils down to one pretty simple question. Is staying in your current zip code really worth that much money to you? Let's figure that out.
Okay, let's talk about something I call the $10,000 difference. Now that might sound like a bit of an exaggeration, but as you're about to see, for millions of retirees, it's a very, very real annual bill.
The gap between the most and least tax-friendly states for retirees is not just a gap anymore. It's a chasm. And this is a big deal for a huge number of people. We're talking over 55 million Americans over the age of 55 who are trying to make every single dollar of their fixed income count.
For a couple with a totally normal, moderate retirement income, the difference can be more than $10,000 every single year. I mean, think about it. That's a fantastic vacation, a new car every few years, or some serious help for your family.
So where in the world is all this money going? Well, to really get it, we've got to look under the hood. There are basically 4 key tax battlegrounds that are going to decide your financial fate in retirement.
Yep. It's a four-front war. You've got income tax, which hits your 401k and IRA withdrawals. You've got property tax on your home, of course, sales tax on pretty much everything you buy, and for some, there's even a estate tax. Now, here's the trick. States play these off each other. A state with zero income tax might have sky-high property taxes, and that, my friends, is the trap you've got to watch out for.
And the reason for all this craziness comes down to something called state tax freedom. Basically, unlike the federal government, every state gets to write its own rulebook. Some states need to fund a ton of public services, so they tax you more. Others are in a race to the bottom, dangling low taxes to attract retirees and their savings. It creates this battlefield of tax winners and losers.
And hey, don't just take my word for it. The Tax Foundation's 2025 report puts it in black and white. They say, and I'm quoting here, the difference can exceed $10,000 per year for a couple with moderate retirement income. The bottom line is, this is real, measurable money that's on the table.
All right, that's enough of the bad news. Let's talk about the solution. Where are the places you can go to really protect that nest egg you worked so hard for? Let's explore the states that have become true tax havens for people in retirement.
The most obvious place to start your search is right here, the 9 states with absolutely zero state income tax. This is just a massive advantage right out of the gate. It means every dollar you pull from your 401k, your IRA, or your pension is yours to keep, at least as far as the state is concerned. These are your top contenders, for sure.
Okay, to make this really hit home, let's meet a hypothetical retired couple. We'll call them Frank and Mary, and they live down in sunny, tax-friendly Florida, one of those 9 states.
So, Frank and Mary have a combined retirement income of $105,000. In Florida, their total state tax bill for the year, which is just from property and sales tax, since their income tax is zero, is only $3,220. Now burn that number into your brain.
But what happens if you choose a different path? Let's flip the coin and look at the other side of this, the worst states, or what we'll call the traps.
Now I want you to meet James and Linda. They have a very similar retirement income to Frank and Mary, but they happen to live in high-tax New Jersey.
So what does their total state tax bill look like when you add up their income, property, and sales taxes? A whopping $11,534.
Let's just put those two numbers right next to each other. The difference is more than $8,300 every single year. Over a 20-year retirement, that one choice, New Jersey over Florida, cost James and Linda over $160,000. That is a life-changing amount of money right there. Okay, so how do you avoid these traps and find your version of Florida? That's what this last part is all about. I'm going to give you a simple action plan to find your perfect state.
Look, if you remember only one thing from this whole thing, please let it be this. Do not fall into the income tax trap.
It is the #1 mistake people make. A state like Texas will lure you in with, hey, zero income tax, but they hammer you with some of the highest property taxes in the country. The only smart move is to look at the total picture. Income plus property plus sales tax, the whole shebang.
Your winning move is a simple 3-step process. First, get a really clear picture of what your annual retirement income is going to be from all your sources. Second, narrow down your search to maybe 3 states that you actually like, that fit your lifestyle, the climate you want, and are near family. And finally, do the math. Calculate the total tax you'd pay for your income level in each of those 3 spots. This turns what feels like an impossible choice into a totally manageable one.
You know, after working and saving for 40 years, the final question isn't just about how much money you have, it's about where you're going to spend it. Because that one decision, more than almost any other, will determine how much of your own hard-earned money you actually get to keep.